In 1982, the Securities and Exchange Commission quietly passed a rule called Rule 10b-18. It did not make front-page news. There was no protest, no congressional debate that anyone remembers. It was a regulatory footnote that got about as much public attention as a zoning amendment in a small Midwestern town. And in the 4 decades since, that single rule has fundamentally reshaped the American stock market, redirected trillions of dollars away from workers and investment, and created a mechanism so perfectly engineered to enrich executives and shareholders that once you understand it, you will never look at a corporate earnings announcement the same way again. Rule 10b-18 made stock buybacks legal, and that quiet regulatory decision in 1982 is one of the most consequential and least discussed economic events of the last half-century. Here's what a stock buyback actually is. Because the concept is simple and the implications are enormous, a company takes its cash that could go toward hiring, raising wages, building factories, funding research, or literally anything that creates real economic value, and instead uses it to buy its own shares on the open market. When a company buys its own shares, the total number of shares outstanding decreases, and when the number of shares decreases, each remaining share represents a larger slice of the company. Earnings per share go up, the stock price goes up, and everyone holding stock, including the executives whose compensation is tied to stock price, gets richer. No new products, no new employees, no new investment, just financial engineering dressed up as shareholder value. And the scale of this is almost incomprehensible. In 2023, S&P 500 companies spent over $795 billion on stock buybacks. In 2022, it was over $920 billion. In 2021, Apple alone bought back $85 billion of its own stock in a single year. To put that in perspective, $85 billion is more than the entire annual GDP of about 130 countries. One company, 1 year, buying its own stock instead of doing anything else with the money. Since 2010, S&P 500 companies have collectively spent over $10 trillion on stock buybacks. $10 trillion. And here's the number that should make you genuinely angry. Over that same period, many of those same companies were simultaneously laying off workers, underfunding pensions, cutting research budgets, and lobbying Congress for tax cuts on the grounds that lower taxes would free up capital for investment and job creation. The capital got freed up. It just went straight back into stock buybacks instead. Which brings us to why this was illegal in the first place. Because before 1982, the SEC treated large-scale stock buybacks as potential market manipulation. And the reasoning was straightforward. If a company is the largest buyer of its own stock, it has both the motive and the ability to prop up its share price artificially. The executives running the company hold stock options. The board members overseeing the executives hold stock. The institutional shareholders pressuring management hold stock. Everyone at the table benefits from a higher stock price. And everyone at the table has zero incentive to stop buying back shares as long as the price keeps going up, which is a textbook conflict of interest that the SEC spent decades treating as exactly the kind of thing securities law was designed to prevent. Then in 1982, the Reagan administration loosened the rules. The idea was that giving companies more flexibility to return capital to shareholders would improve market efficiency. And in the short term, it did produce a stock market that went up. What it also produced over the following 4 decades was a fundamental restructuring of corporate priorities away from long-term investment and towards short-term stock price management. Because once buybacks became legal and culturally normalized, the pressure to deploy them became relentless. Activist investors, hedge funds, and institutional shareholders began demanding buybacks as proof of financial discipline. CEOs who prioritized long-term investment over short-term stock price appreciation got replaced by CEOs who understood which metrics actually got them their bonuses. And that brings us to the executive compensation problem, which is the part of this story that makes everything else click into place. The average S&P 500 CEO now receives roughly 85% of their total compensation in the form of stock and stock options, not salary, stock, which means a CEO's financial incentive is almost entirely tied to the share price of the company they run. And the single, fastest, most controllable lever available to move that share price upward is a stock buyback. It's not launching a new product. That takes years. It's not expanding into a new market. That's risky. It's not raising wages to attract better talent. That costs money. It's buying back shares. Today, this quarter, before the options vest. The result is a corporate incentive structure so perfectly misaligned with long-term economic health that it almost looks designed. Companies run by people whose wealth depends on quarterly stock price movement will make decisions that optimize for quarterly stock price movement. And the single most reliable quarterly stock price movement tool available is a buyback. So that's what they do, over and over. $1 trillion a year, every year. And here's the mechanism that ties this to the broader economy in a way that affects everyone, including people who have never bought a single share of stock. Because when corporations spend $1 trillion annually buying their own stock instead of investing in productive capacity, something doesn't get built. Factories Factories that don't get built don't create jobs. Research that doesn't get funded doesn't produce the next generation of products. Workers who don't get raises don't grow the consumer spending that drives 70% of the American economy. The money moves. It just moves upward into the portfolios of the people who were already wealthy enough to hold significant equity positions. And the wealth gap between shareholders and non-shareholders, between the top 10% who own roughly 89% of all stocks and the bottom 50% who own almost none, compounds quietly every single year. That this continues. Let that sink in. $1 trillion a year, recycled into the portfolios of people who were already wealthy, while the same companies running those buybacks point to labor costs and supply chain pressures as the reason wages can't grow faster. And the uncomfortable truth is this: stock buybacks are not inherently evil in every context. A company with genuinely no better use for its excess cash, returning it to shareholders, is not the crime here. The crime, if we're being honest about what this is the scale, the incentive structure that drives it, and the way it has systematically redirected corporate capital away from the productive investment that actually generates long-term economic growth and toward the financial engineering that generates short-term executive wealth. Because here's what $10 trillion in buybacks over a decade could have alternatively funded. The entire U.S. infrastructure gap, roads, bridges, broadband, water systems, is estimated at around $2.6 trillion. The entire annual R&D budget of every company in the S&P 500 combined runs around $400 billion. The cost of making community college free for every American for a decade is estimated at under $100 billion. These are not small numbers, and yet they are all dwarfed by the amount of capital that American corporations have spent in the last decade buying their own stock to make their executives richer this quarter. The irony that ties all of this together is almost too clean. The companies most aggressively buying back stock are often the same companies most loudly proclaiming their commitment to innovation, their employees, and the long-term future of the American economy. They have the press releases, they have the sustainability reports, they have the keynote speeches about disruption and human capital and building for the next generation, and then they spend $85 billion buying their own stock in a single year and call it returning value to shareholders, which is technically true. It's just that the shareholders they're returning value to are mostly themselves. So next time a company announces a massive stock buyback and CNBC celebrates it as a sign of financial strength, ask yourself one question: what else could that money have done? Because that question, more than any earnings report, more than any PE ratio, more than any analyst price target, tells you everything about who the American corporate economy is actually being run for. Drop your take in the comments. Do you think stock buybacks are a legitimate and efficient use of corporate capital? Or do you think a program that was illegal before 1982 was illegal for a reason, and that the last 40 years have proven exactly why? Because this one splits the room down ideological, financial, and generational lines, and the argument on both sides is louder than most people realize.